Welcome everyone to this Startup Tank Climate Edition session organized by Forward. Today we're going to have 5 fantastic startups pitch their thesis to a panel of investors. I'm very excited to host this. My name is Eva Braniecka, and I'm here with the Forward community, which is the largest local and global community of climate doers, whether that's founders, investors, operators, corporates, researchers, etc., all of them dedicated to the climate action and scaling up some really cool technologies. So before we go any further, this session is live. We have an audience with us, and the session is also recorded. We're going to post it on our YouTube channel of Forward. If you haven't joined the community yet, you're very welcome to do so now, and also subscribe to the YouTube channel for those who will be watching this later. Without any further ado, quick introduction of our investor panel. We have Nelly joining us from Taranis Carbon Ventures. Hi, Nelly. We have Bruce Clark joining from Kalytix Ventures. Hi, Peter. And we have Michał Lasocki from EEC Ventures as well. Hi, Michał.
Hi.
Great. So let's get started. Very quickly, how this event is going to look like. We're going to have each startup present their pitch deck to the investor panel for around 5 minutes. And then we're going to open it to the Q&A for the investors. If any of the audience have any questions, you're welcome to write so in the chat. We have Tiziana, also from Forward, who will moderate the chat today for us. So she's going to help you out as well. I'm going to ask Hemant from Zero Circle to unmute himself and share his screen whenever you're ready, Hemant.
Okay. Hey guys, can you hear me okay? Okay, can you hear me okay?
Yes.
Okay, perfect. Okay. It's nice to meet you all. My name is Iman Seri. I'm based in New York. We are a climate fintech platform focused on mid-market decarbonization. We play at the intersection of small and mid-sized businesses, supply chains, and sustainability, essentially building a fintech layer to accelerate and move the needle for many of these companies that are struggling with their decarbonization journey. So the market for this is really large, right? There's significant amount of dollars that are required to be able to meet many of these compliance and net zero goals that many companies have, whether you're at the enterprise level or at the fintech level, finance level. The challenge are slightly varying depending on who you talk to, right? Enterprises need to decarbonize their supply chain. Mid-market suppliers and SMBs need access to capital, technology, data to be able to figure out how they can actually get through those initiatives. And lenders and investors are looking for high quality deal flows and data for those types of projects to be able to finance this transaction. So if you combine all of these things together, essentially it leads to essentially a $10 trillion of investment that is required to essentially solve the missing middle gap that many of these companies struggle with today. In addition to that, there's a number of other compliance requirements and industry requirements that are forcing these companies to figure out their decarbonization strategy. Think about the global standards, whatever they may be. Many institutions are starting to put carbon tax and other types of instruments on types of your decarbonization requirements. And there's no universal structure and approach for many of these companies to address this challenge. And more companies are spending time just trying to figure out what to do and really not driving any kind of impact. So this, and in addition to that, from our perspective, where we are focused on with the large global market around lending and supply chain transformation, we basically have a pretty large addressable market that we can target. Our expectation is that, over the next couple of years, if we can tap into about 5% of this market, it's $1 trillion opportunity size for us. Now, we do this by basically taking a life cycle approach, and we take a 3-step framework here to do a measure, match, and monetize approach. What this means is basically our measurement program allows these companies to figure out their Scope 3 footprint, their carbon accounting, all of those kinds of elements, and starts to meet some of their compliance goals and requirements that they have. Then we take them through our match process, which allows them to figure out what types of projects and initiatives they want to address within their organization. And then we unlock a lot of capital providers. We started off with about 500. Now we actually have close to 15,000 capital partners that we can actively engage with in some way, shape, or form across a wide spectrum of types of initiatives. Think about your, energy reduction, HVAC systems, recycling, solar battery projects, all of those kinds of initiatives. We can actually find the right investors and institutions that unlock those projects. And then finally, we are able to essentially work with some of those clients and customers to be able to drive monetization programs on renewable energy credits, carbon credits, and other types of funding instruments we can bring to the table. So essentially, we take a whole life cycle approach to take them through this entire journey and leverage AI, data, and technology across that entire spectrum. So today we are driving about 100K in revenue from this year, and we have a goal to kind of get to about $2 million revenue in 2026. We've done a number of early pilots about 2 years ago, and now we are actually driving revenue through some of those measurement programs we've set up for our supply chain companies through our enterprise partners. In addition to that, we've already able to source about $1 billion in capital projects. We're going through various stages of due diligence and capital process with those companies. And then lastly, we are working with 2 different companies to set up carbon monetization and a battery and solar funding program for their SMB players. So basically, we become that full stack operation to drive this. In addition to that, we have about $50 million in pipeline that we're actively working through. And that's kind of where we are. We are looking for some scale to be able to kind of scale up and operationalize the pipeline that we have in progress. The way this would work is we essentially take these companies through this life cycle, onboard the entities. We have a number of different structuring offerings, both on the reporting side, analytical side, compliance side, as well as the lending side. Based on those verified profiles of all these companies, we connect them with our capital partners. And then finally, once the investment has been issued, we track the progress over time and measure impact over time as well. The way we structure this is through our kind of flywheel approach by connecting the platform, data, and the network to be able to drive this engagement model. We've kind of created a significant structural advantage for us, where using a lot of these different components together into this entire life cycle essentially becomes a one-stop shop for any kind of financing structure needs that many of these SMBs are struggling with. And AI is really helping us scale these programs to be able to drive this cost effectively, both for us and for those customers, to be able to meet those objectives that they have on their sustainability and decarbonization goals that they have. Our pricing model is basically a SaaS platform fee for our reporting platform and our matchmaking platform. We take a 1% capital origination fee with our lenders and our investors. And once we launch our carbon monetization in Q1, we'll also have a transaction fee associated with each of the carbon transactions that these SMBs are going to be using. In addition to that, all of this, we're building a data layer around all of this, and we'll start to use that as part of benchmarking and analytics in the future. We have a very kind of cross-functional team. My background is in data analytics and sustainability. I was at Dun & Bradstreet for about 10 years. I ran their risk and compliance organization, and I launched the first ESG ratings at Dun & Bradstreet. My partners are Shilpa. She's a fintech executive. Many years worked at Adyen and Finastra and Uber. And then my 2 partners in India, Pramod and Abhi, both help us on the operations and marketing. All of us are entrepreneurs. We've had multiple companies that we work with and exited, and now we're trying to put this team together. In addition to that, we have a kick-ass advisory team. The chief sustainability officer for FedEx joined us recently, and the senior vice president at Schneider was one of our first angel investors as well. And we kind of are driving a lot of the engagement through their network and through their activities on the supply chain side. Just to compare ourselves, again, this place is a very crowded market. There's a number of different players focusing on very different things. Our sweet spot is mid-market, supply chain, decarbonization using fintech is kind of our approach. So we kind of cross-function with a number of different players that are overlapping in different areas, right? And what we are trying to do is kind of take that horizontal approach using finance as a layer for decarbonization. What we're seeking is a $1.5 million seed round, essentially to scale up our operations. We've been in business for about 2.5 years now, and this year was the first year we started generating revenue. And now we really need to scale because our pipeline is actually pretty strong, and we need to start hiring more people to be able to kind of take on some of that pipeline activity, and also build foundational technology that we've already built for now, and leverage more of that AI capabilities to be able to scale up in the future. Thank you for your time. Happy to answer any questions on Zero Circle.
Thank you, Hemant. We're going to have slightly less time for questions for this one, but I think we're still going to be able to ask plenty of interesting questions. So I'm going to start very quickly. So the product manager in me is wondering about the different parts of the platform that you have. So to understand, are they all live now? And if they're not, do you plan to roll them out at different times, or what's the plan there?
Yeah, so they're all going to sit eventually on one, SaaS platform. Right now, they are in parts right now, and as we are getting customer traction on each areas, we are starting to fold that into the SaaS platform. The reporting platform is live. We've already rolled out for about 100 companies, and we're building the carbon monetization platform right now. The marketplace is in process of building right now.
For that. And then I'll just leave the rest of the time for the investors to ask the questions. Go ahead, Peter, Nelly, and Michał.
Sure. Thank you for that. So I've noticed, obviously, you've got the first 100K that's come in. In terms of like a breakdown of what that revenue represents, is that like SaaS? There's the consulting aspect? I'm getting a sense that it's like a sort of big platform that involves consulting, SaaS, and marketplace. Is that sort of accurate?
That's accurate. Today, it's about 50% SaaS and 50% consulting today, approximately. To be fair, last year and a half, we basically did a lot of consulting for free. So we were not charging until we were getting the platform built up. So now going forward, we'll actually start charging for more of that consulting services going forward.
Okay, so I was just wondering where your margins might be in each layer, and where you see that kind of growing, and where you see like the bulk of the business growing in terms of revenue attribution.
So the first year and a half, close to 2 years, I would say, would come in through the origination, because while it's not recurring revenues, it's transaction revenues, and it tends to be pretty large anytime we success, right? Anytime there's a transaction that closes, right? So I would say the first year and a half to 2 years is where we would get majority of our revenue through the transactions. And then by year 3, it would flip into the SaaS revenue going forward. And consulting, we're not trying to be consultants, so we are basically working with partners, and where we can fill the gaps, so we do some, high-level consulting and basic consulting, but we are not trying to be a consulting organization.
Cool. Another just question around regulation. So if it were to slow, what would keep banks using you?
So that's funny, right? So obviously, the landscape has been changing, but because we've been focused heavily on the finance side, investment hasn't slowed down. The only thing that has slowed down is how they are tracking those investments and connecting it to regulatory drivers around decarbonization. And in some parts of the world, they're a little bit slightly different and ahead. And obviously in the US, they're slightly behind. So there's a lot of momentum around it. But because our core proposition is around the fintech side, we really have to adapt our financial metrics to the way localized regulations that are in those markets. So I'm actually not too concerned about it. Initially I was, but because we're not a reporting platform at the end of the day, right? We need reporting as a means to an end. And we partner with a few partners already. Like Schneider is one of our partners, and we use their carbon accounting platform as part of our overall reporting assessment. And we have a few others that we're working with right now. So we will work with our partners, and we'll put all that data analysis together to meet the localized regulatory drivers for the various financial institutions.
Awesome. And then just one last question. So would it be fair to say that the defensibility around your sustainability scoring is a function of like the data that you're generating through the platform? Like, what is the moat exactly?
So on the data sides, it's a combination. So there's some data that we do on our own. We have a bunch of AI tools and models that we built on our own. We source directly from the customer because there's a customer engagement model, and we have a couple of third parties that we engage with as well. So it's going to be a combination of all of that. The objective is not to be the the universal scoring for these kinds of projects. The objective is to meet the regulatory drivers and the funding drivers for each of the institutions. So really what we are trying to do is customize our approach with all this data available to the right capital partner that's looking for it. So because we have the foundation and the pipeline built up, we can tweak it very, very quickly for a new type of investment vehicle or a new type of funding structure based on all the data attributes we have today.
Awesome. Well, it seems like you might need quite a lot of customer support with all this inbound. So
yeah, that's kind of where we are, unfortunately.
Okay, so maybe just like a quick question. I don't understand if you have developed your own life cycle approach or if you are like relying on existing one.
Yes, we have our own kind of approach, and obviously we're adapting it based on how we are engaging with the customers. So we've taken your traditional kind of investment and lending life cycles that already exist, but layering on this kind of new type of data attributes and elements on top of that life cycle. So that's kind of how we are approached it, right? We're not trying to change existing investment life cycle that's been proven many years, right? But what we are trying to do is kind of add in this kind of new segmentation of analytics on top of that existing life cycle, and then we are basically building our own version of that same life cycle through our platform.
Okay, thanks.
And I want to make sure investors get to ask questions. Michał, is there anything from you towards Hemant?
No, thanks. I'm fine.
Okay, great. So we do have time for one more question if Peter or Nelly have any questions left at this point. Okay. And so I'm going to then pick up a question from the audience because there's plenty. So Luke has asked towards Hemant, who do you currently work with for commercial solar and storage? I'm not sure if this was mentioned
we
in
have a couple of partners. It's actually one of our partners. We are doing a strategic relationship where they have a battery provider and we're working with them. It's a sodium ion battery. And then we are setting up the finance layer for that particular program. But we are agnostic. At the end of the day, we are a finance platform. So we will work with multiple providers as required. So happy to kind of chat separately on how we want to engage with battery and solar vendors that want to work with us.
Fantastic. Thank you so much for answering. And great. So we're going to move on to the next one. Thank you, Hemant, so much for your time, for your presentation and investor questions. Quick reminder, so I forgot to say this after Jamie has finished his presentation. If the founders can and have time, they can maybe address some of the questions from the audience in the chat. Again, if your focus is there to do it. Great. We're going to move on to the third startup, which is BAIE Minerals, and Mike is going to be presenting. So go ahead and share your screen when you're ready.
Thank you. Okay, my name is Mike Sullivan. I am the co-founder and the CEO of BAIE Minerals. So what we do is we transform mine waste into decarbonized minerals. So we're a tailings technology company. So what problem are we solving? Well, we are addressing orphan and abandoned mine waste. It's environmental injustice, it's pollution, and we are targeting more the unfundable environmental liabilities that are associated with hard to abate mine waste. So looking primarily in North America. So in Canada, there's more than 11,000 of these orphan and abandoned mine waste sites, and there's more than 49,000 in the US. So we target a specific type of mine waste, alkaline mine waste and acid mine drainage. And so our solution is we have an upcycling technology, and it's coupled with a circular economy business model. It's considered progressive reclamation because we transform these mine wastes into decarbonized minerals and carbon credits, and we go into the decarbonized markets, which are cements and battery markets. So what is our business model? Our business model is that we have a waste to value refinery. So our feedstock is alkaline mine waste and acid mine drainage. So they kind of offset each other. And primarily our technology is hydrometallurgy and where we acid leach the minerals out of certain types of alkaline mine waste. The technology is safe. We detoxify any toxic material that are in it, and in this case, it's asbestos fibers. It's scalable, it's sustainable, it's low carbon, it's low cost. We get more than 90% mineral extraction, so we have very little waste left behind. And we primarily target magnesium and magnesium oxide, which goes into the cement industry, and the target that we have here is a silica as well, and it goes into the cement industry, the supplementary cementous material. And the target that we also have is nickel manganese cobalt, which is 0.4%. It seems small, but it's actually quite commercial at that, and that goes into the battery metal market. So we have a highly defined product market fit with what we do. So the magnesium oxide market, it attracts a price of between $500 and $700 a ton. The big market for is a magnesium oxide cement board. It's a very mature market. It's growing rapidly. It's $5.6 billion. This is mostly the North American market. And our customer in this is the Magnesium Oxide Cement Association. They have 50 different customers that are in the channel that we deal with. Some of the traction we have is confidential, so I just want to say that it's mostly working with the Cement or Oxide Association. The amorphous silica goes in the supplementary cementous market. It's a very big market, $36 billion a year, growing at about 6.5% a year. Our market that we can attract is around $250 million a year, and we are a part of the Global Cement and Concrete Association, which is a global market and highly big demand for decarbonized cement and concrete material. The nickel manganese cobalt, a smaller part of us, but still very big. It's a big market that goes into both of these products are either in the battery market or in the stainless steel market. And we also have a carbon removal attribute that comes with our alkaline material. So we have traction in the carbon dioxide removal market. It's around $200 a ton. It's a big market, and we have customer traction in that space. What does it look like? Well, we can go scalable right to commercial scale. And so our pilot that we have is large scale mine waste. A small modular plant has got a 100-year reserve life index, and at less than half a million tons per year, we have a gross revenue of over $300 million a year. If we were to scale this up at 3,000 tons a day, which is 1 million tons a year, we're close to $800 million a year with a 50-year reserve life index. Our economics are fairly robust. We have more than 100% IRR and pay out less than 2 years. And we have a highly defined exit strategy in the marketplace with our customers. So what is our competitive advantage? Well, the status quo is that it's toxic mine waste. It's hard to abate. It's really viewed as an unfundable environmental liability. So there's typically been no solution, or historically been no solution for it. So there's limited competition because the market's looking for a value proposition for this, to pay for the cleanup of this environmental liability. So what we do is we have a commercial solution that is our technology. We detoxify the waste. We have a low-cost mineral extraction, and we have a robust waste-to-value economics with strong customer demand. So our secret sauce is our patented proprietary technologies. We have a circular economy solution. We have several strategic advantages that we can talk about in confidence that basically give us a moat on our business model. So who are we? I have over 35 years of experience in resource extraction, and mostly in the waste management side. We've rounded out our team with lots of mining and mineral experienced people. And we also work with PhDs and science advisors from National Research Council, from Research and Productivity Council, and SGS. So we have a well-rounded commercial and technical and science team, and we have recently hired a PhD that is going to become our Chief Technology Officer to advance our technology forward. Commercial time frame. We actually can be quick to market. We are basically at the pilot stage funding right now. We have secured $1.3 million in grant funding, and we're looking at raising approximately $1 million. We have a very quick environmental registration. It's brownfield, so it's easy to get permitted on mine waste that is brownfield or disturbed sites. We have customer traction already defined, so we can become in operation fairly quickly. And so what our ask is that we're looking for $1 million for 10% of the company. The $1 million can release almost $3 million worth of funding because we have grant funding behind this, and basically it's a catalyst. Equity funding that we're seeking is a way to unlock a lot of grant funding on this side. So why now? Well, we're a for-profit, for-purpose business model. We take mine waste, we apply green technology, we protect communities and the environment, we make sustainable minerals, we make profits in CO2. So the technology is a solution for pollution. It's a proven technology, it's ready. The market is ready. We get strong customer demand, robust economics, a viable waste to value business model. But more importantly, the mine waste is readily to be converted into a resource. It's high scale, it's low grade, it's low risk, and we have strategic locations that we're targeting with a number of competitive advantages. So this is a picture of one of the mine waste sites that we're working on. It's a large dry stack tailings. This is from an asbestos mine. It's highly alkalinic. What we do is we upcycle value from the mine tailings. It's a highly sustainable, highly profitable business model, and clearly defined waste to value proposition. That's our pitch.
Fantastic. Thank you, Mike. Very interesting. And I just can't wait to hear the investor questions. Nelly, I saw you unmuted yourself, so go ahead.
Oh, yes. So, hi, Mike. Thanks for your presentation. Maybe just one quick question. Do you have to pay for the feedstock? Is they considered as waste? Are you getting paid to treat it?
No, and that's part of the problem is that there's no tipping fee. So what this is orphan abandoned. The original miner, in a lot of these cases, let me just sort of back up. In the mining industry, the reclamation and the cleanup of the site happens at the end of life of the mine. In a lot of cases, it's end of life of the company. So unless you fund the reclamation up front, it's in today's environment, you have to fund that up front. So these legacy mines, and there's lots of them, they're orphaned and abandoned, they're under control of the government. And so in North America, and I'm going to talk about Canada, the government always owns the resource, and you lease it from them in exchange for royalty payments or production payments, leasehold payments. So we don't pay for this. What the government wants is to get royalties and revenues from this in the form of taxes and job creation. And they want it cleaned up. So it's a form of progressive reclamation. So every ton that we turn into a product that's sold into the cement market is one less ton of waste.
Okay, but you still have to pay for the transportation of this kind of stuff.
Well, we would be doing everything on site. So on site, we would. So we have export capacity right at a lot of these sites. So we look at a lot of mines are in remote locations. Our giant pilot project that we're doing right now is right on Tidewater, and so we can get into the European market. We can get into the Eastern Seaboard market. So we don't have to transport it anywhere. We'd be processing right on site.
Okay. And just like maybe one other question on this, like more like on the CDR point of view, do you see any competition with like enhanced rock weathering and ocean alkalinity enhancement technology, because they are always also looking for mine waste?
Yeah, and to a large extent, we'd be partnering with them. There's no sense. This is a very, very large mined waste site, so it's almost an inexhaustible supply. So partnering with them makes more sense than trying to compete and go on your own. So what we're doing is we're creating a carbon mineral hub at our sites so that we can have a carbon model and a mineral model. The carbon model actually doesn't clean up the site. You're just using it as a repository. So in a lot of cases, the government wants these sites cleaned up. So that's the extraction of the minerals. And the big mineral that carbonates is the magnesium oxide.
Okay, thanks.
Thank you for that. So we do have time for either 2 short questions or 1 longer question. So if Peter or Michał have either, then go ahead.
Well, I do have quite a few questions, but I'll limit it. I guess obviously you're going through this pilot right now, and I thought what would be helpful across the kinds of products that you can basically create through this is what is like the recovery yield per ton, or that you project to be, versus today's tailings reprocessing benchmarks, and at kind of what cost per ton recovered, and then like who would be buying it and at what discount or premium?
So we're making a decarbonized cement mostly. So we don't actually get a premium, but we get priority from the buyers. So the cement, and we've recently joined the Global Cement and Concrete Association. We have 7 parties that we're contracted with. They are being mandated to be decarbonized. So they want a low carbon footprint product. And so we get, we don't necessarily get a premium. There's not a premium associated with it, but there is a priority. The extraction rate that we get is over 90%. So we take what is waste. There's maybe a 10% residual left over. So it's a high yield. And what we're doing is actually leaching out the alkalinic material, and then we're precipitating some of the metals out. And so as we clean the product up, and based upon the spec that the customer wants, we'd have more of these byproducts, these metal byproducts, which the higher value one is nickel, manganese, cobalt.
And so just out of curiosity, so if you had commodity prices that fluctuated, say, by 30%, how would that impact your business?
The cement industry and the construction material space fairly stable. They're not, they're negotiated, but the prices are fairly stable, and they kind of track inflation, but they're not, they don't have a lot of speculators in there, manipulating the price. Nickel, manganese, cobalt, you might, but it's 0.4%. So the industrial mineral market is a market that isn't widely opaque. So, but you're negotiating with big customers, the big cement and construction material space players. So you're negotiating long-term offtake contracts. So there's very limited price fluctuation.
Gotcha. Thank you.
Thank you for that, Peter. Michał, do you have any questions as well?
Yes.
Go ahead.
Guys, hear me? Can you hear me?
Yes.
Thank you for the impressive presentation. I'm curious to find out, this is your experience, 25 years of experience, right?
Yeah.
How much of that is packaged into the company, and how much of that can actually be turned into a IP, and how much is your experience, which is kind of attached to yourself as a person?
So a lot of my resource extraction experience has been in oil and gas, not necessarily in the mining space, but most of it's been in waste management. The resource extraction industry is a very big waste generator, and the mining industry is even bigger. So they get a small amount of high value product and a big amount of waste. And so a lot of it's transportable. This is what we're targeting now is kind of unique. There's limited competition. What we found is that there's a lot of technologies that are available, from the pharma sector, from the agricultural sector, that can be transferred into the waste extraction industry in the resource sector. So one of the technologies we have is hydrodynamic cavitation, which is used in valorizing agricultural waste, and we found that it was highly effective in what we're doing here. So a lot of it is working with science institutions and parties that have developed technologies from other sectors and transferring them into the waste side in resource extraction from waste.
Thanks. Thank you for your explanations.
Great. Thank you so much. And it's all the time we have for questions. So thank you, Mike, so much for your presentation and thorough answers. And we're going to now move on to the fourth startup, yes. So we're moving to quite a different sector towards mobility, an earlier stage as well. So Paul, whenever you're ready, you can unmute yourself and share your screen.
Great. Can you hear me okay? Are you able to hear me okay?
Yes, I can.
Okay, perfect. Great. Well, thank you everyone for your time today. My name is Paul Breslow. I'm the founder and CEO of Crewz. And we think we're the most valuable shared ride app for all riders and drivers. And this is a first step towards a universal P2P sharing platform based on trust. So it's definitely a first step because we believe that transportation is a gateway for all humans to be able to collaborate and establish trust. And simply put, we save riders and drivers 40 to 100% of their time, their money, their emissions, and we enable everybody to make new connections on every ride. And we think that's really important to think about it from a triple bottom line perspective. So from a problem perspective, existing transportations simply are not really effective. Transportation is the second largest household cost. It's increasing. Public transit often takes twice as long if it's available. In Europe, of course, it's much better than it is here in the US. The ride hailing from Uber and Lyft and others often costs twice as much if it's available at all. And COVID really killed the carpool industry. So when you think about kind of the transportation options, carpool is the most affordable and often the most comfortable and convenient. So from a context perspective, a lot of people think that ride sharing is solved, but it isn't. Uber and Lyft are only about 1% of the rides out there. Google's Waze Carpool, they proved the market with 1 million rides a month in the US. Carpool is often much cheaper, often about 75% cheaper than a TNC, the transportation network company, the ride hailing, like Uber and Lyft. And now in the US, the carpool drivers can earn net almost as much as the TNC drivers, the ride hailing, and actually more if you think about it on a dollars per hour basis. And we focus on the 99% of rides. We really make them social, and there's essentially no competition in the US. So from a commute perspective, I think it's pretty obvious. The riders, they have the choice between, driving. It's very difficult, often don't have a car. So they're thinking about transit or ride hailing. It's very expensive. And the drivers are often looking for extra money. So the question is, how do we facilitate the solution? It's obvious, of course, it's carpooling. It's much cheaper. And we feel like it's a better solution than traditional ride hailing. And it's at the cost of public transit, more or less. And specifically, you can really save tens or hundreds of hours, especially get access to the high occupancy toll lanes. You can earn thousands as a driver and really create new contacts, which is very difficult, especially for Gen Z. When it comes to events or airports, it's even more challenging. Anybody who's done the parking or taken an Uber or something, between surge pricing, event parking, of course, it's very difficult. The way that we address that, of course, is by enabling some sharing, pair people together with scheduled rides. It could be upwards of half the price. It could be even faster. It's nice to be able to reduce the risk, reduce the stress, be able to save as much money sometimes as the ticket cost, and maybe meet some new neighbors that are very interesting for you. So why now? So this is the question we get a lot from sophisticated investors who said, hey, Paul, of course, carpools existed before. Yes, but it's a little bit different now. So from a regulatory perspective in the US, all of the electric vehicles have been kicked out of the HOV lane just last month. So they're interested in solving that problem, getting access to it. From a competition perspective, COVID really killed the carpool industry. The Uber prices have doubled over the last decade, so it's getting very expensive. From the driver supply perspective, drivers are really getting pinched by the Uber and Lyfts out there, and the regular drivers like you and me, it's nice to be able to earn a significant amount on a per hour or per mile basis. And then, of course, we have technology. With AI, we can reduce the two main frictions, which are the logistical aspects and also the social aspects. From a market and go-to-market perspective, there are about 1 billion rides per day in the US. We're starting first with events and other markets in the San Francisco Bay Area. From a TAM, SAM, SOM perspective, of course, it's huge. 2 trillion going down to perhaps 600 million, what we might hope to achieve from gross market value perspective by year 5. As I mentioned, we're starting with events locally, whether it's small biz networking, going to larger events, concerts, and conferences. And this has been proven before. And then going to the commute use case, which is much larger, and then also airports. And that becomes a flywheel that sort of reinforces itself. There's other types of revenue, whether it's coming from government contracts, parking revenue, referrals, and tolls. And a simple business model is the riders pay the drivers on a per mile basis, and then we charge a transaction fee on top. So from a competition perspective, there have been others like Waze, which has been shut down, and Scoop, which is effectively sold off for their IP. But we are really the only dynamic, meaning you can schedule a ride for a couple hours from now. You can go to an event tomorrow. It's not a bulletin board style, very social focused, and it's a low friction, making it very easy, trying to get towards one button push, because all of us have these types of devices, and that knows exactly usually where you've been and where you're going. There are a couple other solutions, but they're very different in terms of their business model and their approach. We're very differentiated from a technology perspective, timing, hybrid model, IP, and our go-to-market approach. So myself, I've worked for a couple of European companies. I know most people here are European. I spent 7 years running EDF's innovation team here. I saw many different things across marketplaces. Worked with Theo before, and Leo's been product designer and manager across many different products. We have several carpool executives on our team as advisors, VCs, and how to design. We're raising our pre-seed. We've launched already with event partners. We're initiating some partners with some well-known universities, raising funds to be able to do marketing, implement some AI and partner integrations. We have 2 patents around multi-currency marketplaces and group matching, which is important. That's our timeline. And this is an example of the product, which was actually used at a Forward Climate Meetup that I co-host here in the Bay Area. And this woman was able to save 75% compared to Uber and save half of her time compared to transit. Thank you very much. I appreciate your time.
Thank you so much, Paul. I was really curious about that last slide. You rushed through it, but I was really curious to kind of see how things look like when you compare them between Uber and Caltrain and Crewz.
Yeah, it's pretty expensive. Maybe $60 for her trip, and she paid, I think, about $13. Yeah, $13. And instead of almost 2 hours,
right here.
What's that?
That's European prices. These things tend to be really cheap in Europe somehow. But yeah, awesome. Thank you so much. And I'm going to open the floor for questions now. So I have a very quick question because I'm an avid user of BlaBlaCar myself, being European and all. And I am just curious, we probably studied that area much more than I did. I'm just a customer here. But what do you think were the reasons why like BlaBlaCar didn't enter US, or why things didn't stick there as much as they maybe do in Europe? I could imagine something with like prices of fuel and everything, but maybe you have an answer to that that's more robust.
Yeah, I think your question addressed all of the issues. So it's not that they haven't tried. They have tried it. They've come in multiple times in different ways. One was just trying to get into it, and then they felt like it was a very different market, very expensive market, very challenging from insurance and other perspective, which it is, as well as to your point, the market here has been relatively low. We have long distance rides or very short, and the economics are not the same, as well as they have actually tried to acquire several companies in here, which we're aware of, and so potentially that could be an exit strategy at some point.
Great. So Peter, Nelly, Michał, go ahead.
Sure.
Hi.
Oh, go ahead.
It's just a question. So the model of carpooling is essentially like BlaBlaCar, but in your presentation, you mentioned that they are focused on other geographies. So are you like BlaBlaCar, but for the United States, or are there any differences, especially in the way you operate, that makes you different from them?
Yeah, so BlaBlaCar has a commute product and a long distance product. I think the long distance one's been used more, but I'm not sure. So we do have commute and we have long distance. So we are similar in terms of the basic functionality with what you might call traditional carpooling. You or I, who are not professional drivers, who are going somewhere, and we can make a little bit extra. In addition, we had a couple specific things that are very different. We enable sharing of an Uber or Lyft. So for instance, every time that you arrive at San Francisco or Charles de Gaulle in Paris, you know that everybody else getting on a plane is probably going to go one of a couple of directions. And that means that likely half the people you could share a ride with in some direction. Right now, we don't have anything that enables that. That enables you to save 40%. That's highly differentiated, as well as our focus on really the social and the community. And then we have IP around both that social matching aspect with groups, as well as the multi-currency marketplace focused on the concept of trading credits as well as fiat currency. And that gets you to a point where you can have an extremely low marginal cost, really high value, very disruptive, even free transportation system.
Thank you.
Thanks. Peter, you had a question?
Yeah, for sure. I mean, like, obviously, the elephant in the room is around Uber and all of these other rideshare companies discontinuing carpool, right? And so what I'm just really interested in is, like, what have you exactly cracked in the economics that has suddenly made this viable now? So cost base, routing efficiency, etc. But when I went through all of the reasons why a lot of these companies shut down, it's usually because the consumer has preferred actually reliability and being in the place at the right time versus having to rely on the itinerary, right, of pooling. And I'm also talking as someone who used this when it was around in San Francisco. So I totally get it.
Yeah, great question. So a lot of it has to do with the technology and the timing and our model. So for instance, when we're making, let's say, upwards of 70 cents per mile tax and insurance free as a carpooler, compared to where it was a decade ago, is very different. And to your point, Lyft started off as a carpool company called Zim Rides, and they transitioned out of it upwards of 10 or more years ago. Uber's never had any type of carpool solution. Their model is predicated on being able to have lots of liquidity in the market, lots of riders and drivers. If you've ever spoken to an Uber driver, like I can imagine every single time, my wife doesn't appreciate it. I'm always interviewing the driver, but they're very unhappy with especially the what's called destination rides. So when I want to, let's say, go from out of the city into the city to work for the day, it's very difficult to get that ride that I want in and home at night. And so we're able to, have a value proposition for them that's very different than for the Uber drivers. And then, of course, just being highly disruptive in terms of having a share product that works. Right now, when I take it from San Francisco back home, what happens to me if I do the share button is I save maybe 5 or 10%. So instead of $40, it's $36. And then my half an hour trip becomes 1 hour with a person I don't have any knowledge of or awareness of. So it doesn't work at all. It's a broken product. So most people don't use it.
Got it. And just out of curiosity, so what kind of population density and utilization would you expect to break even?
What you mean in terms of how many users we'd need, or what do you mean in terms of density?
Yeah, as in like
That's a very specific name for us.
No. As in, like, is there like a certain level of like within a city population density that makes this work? Like, you're talking about that case, right, of then bringing people back at the edge case, but what's like the kind of bell curve of the normal distribution of like utilization, right, and how it actually works? Yeah,
it's a great question. So this is something I led a lot of our peer-to-peer and energy marketplace research at EDF when I was there for a long time. And as you can imagine from electricity, it's very four-dimensional, it's very instantaneous, and the exact same problem in transportation, right? Peter wants to go somewhere and Paul wants to go at the same time. So it could be a small college in the middle of nowhere where all of a sudden all the kids are going home for the holidays. It could be to an event at the specific time when it starts and it stops. So the density is not necessarily around a certain amount of population. It's around being able to get the same people going the same place at the same time. Or being able to have, for instance, an employer where you have a number of people where you know are going to operate on a very routine basis. And that's why we operate across all those use cases, such that we become that third app in the US. There's Uber, there's Lyft, and there's Crewz.
Gotcha.
And maybe like just another question, like, do you have any feature to make it more social?
Yeah, it's a great question for sure. Yeah, so that is part of where what we're really trying to build is a community operating system that enables us to transact in multiple services. And as a personal story, my daughter was having a challenge, and we created a carpool, and it was really interesting watching her best friends come out of that and come out of depression as a result of that. And it made me realize that carpooling enables us to have transactions which lead to interactions. And so part of what we do is we surface from people's backgrounds that they allow us to access to be able to say, oh, Nelly and Paul, you're both interested in climate tech. You're going to have a great conversation. And so half the people we speak with here in the US are more interested in the social aspects, especially Gen Z, which has maybe fewer experiences with building networks and connections and friendships. All of us could use more community and more friendships, but it's very difficult. And we try to surface that every time people take a ride.
Okay. And do you have like any security features, like mainly if you are a woman or like for this kind of?
Yeah. So 2 parts. The simple one is you get to choose who you ride with. You can invite them or accept as you like. The second part is being able to create what we call sort of a trust graph. And so the data that people provide that we're able to get publicly, we're able to create a graph of how comfortable, what Paul has that looks trustworthy. So you can see perhaps his LinkedIn, you can see ID verification, if I chose to do a background check. But as you can imagine, the more things we ask users to do, of course, that creates more friction. So we want to make it very easy to make it as frictionless as possible and give users as much information as they feel is necessary to be able to make a good choice.
Okay, thanks.
Thank you.
Fantastic. Okay, thank you so much, Paul. Unless there's any other questions from the investors. Give it a second. No. So thank you so much, Paul, for presenting and answering the questions.
Thank you.
Great. And we're going to move on to our final startup. We're supposed to have 6 startups today, but one of the founders had an emergency coming up, so he wasn't able to join. But we're going to move on then to Kit from BioTwin. Whenever you're ready, Kit, go ahead.
Okay, great. Hello, everyone. Thanks for staying online. My name is Kit Chong, CEO and co-founder of BioTwin. We're replacing steel studs in partition walls with hemp-based ones. And that's me in the middle. I'm no stud, but I'm holding 2 traditional methods of holding up a plasterboard. So every modern wall hides a big climate problem. Each steel stud emits around 3 kilograms of CO2 and billions are installed every year. Architects and contractors are now losing projects for not meeting low carbon specs. So if they can't prove carbon performance, they're out. And right now, regulation and market demand are converging. Cities are tightening embodied carbon limits, and corporate tenants want low carbon buildings, and green certifications are now the norm. So buildings that can't prove it are seeing falling rents and values. And this is also known as the brown discount effect. And then investors are shifting to cleaner assets. This change isn't optional, it's here, and materials that can't prove compliance are being dropped from tenders. And our answer is a patent pending hemp wall stud, made from hemp fiber and hurd. It cuts embodied carbon by 71% compared to steel, verified by R2 LCAs. and it helps every stakeholder from building owners and developers to architects and contractors align their projects with net zero goals. And we're not just another green prototype. We've completed full fire, acoustic and structural testing to UK and EU standards. Our UK pending patent and international PCTs covers both material composition and manufacturing method. And we're hard to copy. Our custom machinery, material composition, and know-how in the supply chain form real barriers. So where there are internal walls, we can make money. We're entering a $38 billion global steel framing market, but focusing first on non-load-bearing commercial retrofits, which is a fast-moving low-barrier wedge worth around $2.5 billion. Our near-term target is to reach annual sales of $22.4 million in 5 years' time through office, retail, and hospitality retrofits. And each new low-carbon specification or sustainability-driven project expands that opportunity. And we already have traction. Our first international pilot is live in New York with the city's Economic Development Corporation. They were really eager for us to be part of their first pilots at the Brooklyn Army Terminal, and we have now plans to integrate our studs into other real estate in their portfolio. Next pilot is a London Science Park retrofit with Imperial College in Acton. This is followed by a commercial project with HSBC. So architects and contractors have been in touch with us and they're requesting specs now based on our test data. In terms of competition, well, steel is cheap and familiar, but high carbon. Timber is greener, but heavier and limited by fire ratings. So we sit between the two. We're light, fire safe, and quieter than steel. So we're the only company with a tested patent-pending hemp stud for commercial interiors, and gives us a clear technical and timing edge as carbon rules tighten. Right now, we sell directly to developers and contractors through pilot projects and retrofit orders. Once production scales, we'll expand to regional distributors for volume. With our in-house thermoforming production line, we'll reach cost parity with steel at 30,000 units. And at scale, we can reach cash positive by 2027. Revenue grows from $250,000 next year to 16.6 million by 5 years' time. And that's all with a single product line before we expand into other framing and panel systems. Our team knows how to build and scale. I founded and scaled 2 startups to exit. Matt Elton, our CTO, ran manufacturing and construction businesses and leads our product development. Paul Dwyer, our commercial officer, has 2 decades in commercial strategy and operations. A great coup for us is Jane Goddard. She's the deputy CEO of BRE and advises us on certification and go-to-market. Right now, we're raising £2.6 million to scale manufacturing, fund production, and grow our commercial team. We already have interest from SFC Capital, One Planet Capital, and Ventures Together, and we're now bringing in a lead to close by early 2026. Well, steel studs haven't changed since 1925. It's actually 100 years old. And BioTwin has re-engineered the wall stud for the net zero era. And we've built, tested, and proven a product. Now we're ready to scale manufacturing and decarbonize the walls that surround us. Thank you for your time.
Fantastic. Thank you so much, Kit. Short and to the point. So let's open up the floor for questions. And I actually, if I may start with a quick question. So you did say you have a patent pending, but I imagine in that area you also need certain certifications. So do you have everything that is needed to sell at scale?
Yeah, so actually for interior wall partitions, there is no certifications. What we have done is done a lot of testing and benchmarked it and worked with board manufacturers like the gypsum boards and complied with how to hold up those walls. So structural load testing, fire resistance. Added benefit we've done is also do acoustics testing. Because we're going into non-load bearing walls, there's less scrutiny and building codes around that. As you go into more the structural elements of the building, then yes, there's more scrutiny and certification required for that. Actually, our future plans is actually to partner up with the board manufacturers and then offer as a whole system. So you have the studs, the boards, and the insulation, and then be certified and warranted as a whole system.
That makes sense. Great. Thank you so much. Peter, Nelly, Michał, go ahead.
For sure. Thank you for that. And obviously, like, it's a incredible, sustainable product. I'm just wondering how this translates into commercial advantage and whether or not some of what's kind of happening with the switch might be to do with embodied carbon regulation. So can you just talk through that?
Yeah, we've been speaking with lots of architects, contractors, and property developers, even building owners. That's the real crunch for them is the embodied carbon limits coming down the line, or they have to comply with in order to get permits or allowed to do any of their building projects. So that's in their mind. But on the demand side, it's really that the corporate tenants have been pushing the building owners and property developers to do this, because they also have ESG targets. Some have also stated that they've got net zero targets by 2030, 2050. So they have their own shareholders and stakeholders to work with, and if they're not in a green building, then there'll be questions asked. So that's pushing the demand side and putting pressure on building owners to then think about, well, how do I retrofit this? Operationally, they've kind of figured that out. You can have LED lighting or heat pumps, HVAC systems that are very efficient. When it comes to the actual materials that they're putting in, that's where they lean on the architects, and that's where we're getting a lot more inbound interest from the architects. And then that gets pushed down to the contractors installing the product. So I think we're seeing that sea change more so in the commercial environment where you have office retrofits, retail and hospitality.
Gotcha. And then sort of install cost per square meter of partition, if you include labor and fixed things, how does that compare with steel? Like, where's the payback? Thinner boards? Is it faster install or less rework? Or
yeah, a great question. We actually engineered this product so it's a like-for-like swap with the steel stud. Same profile shape, same width, and it goes into the existing system. So you still have a steel top and bottom track, and we slot right into that. No extra training required by the contractor. No extra tools. You can use a chop saw to cut our stud to size. In terms of price points, currently as it stands, we're doing batch productions with our manufacturing partners and ordering in batch of the material. And so we're right now 8 times more expensive than a steel stud. There are some contractors that are not willing to pay a premium. We've experienced this on one of the pilots where they said, look, I can buy a steel stud at this price, I can order it online, and that's how much I'm willing to bear, which is fine. They were not as sustainability focused. Whereas with the HSBC projects that we've got coming up, they were actually willing to pay £25 per stud. So we haven't worked out the pricing strategy just yet. But I think if we really want this to be mainstream and make an impact, we have to get very close to steel cost and be parity with that. And we are actually working towards that with our new machinery and driving down that cost. And it will be a slight different material makeup, but that material makeup is actually going to be even lower carbon footprint than as it currently stands.
Gotcha. Thank you.
And just to add on, like this, the cost of your stud, do you have any, like, what are the main levers that you have to work on to reach like cost parity?
Yeah, so right now we have a 3-step process to make the stud. 2 of those processes is working with our manufacturing partners based in Germany and Poland. If we move this to our new machinery and work up this pilot production line, we can eliminate those 2 partners. And that's really where the cost lies, is working with them, using their facilities, setting the parameters of the machines. And so actually when we move to our new machine, we can actually do 1-step process and actually have a faster output. It's going to be more efficient and at a lower carbon rate. So yeah, that's really where the cost lies, is actually working with manufacturing partners.
Okay. Thanks.
Any question from Michał, so that every investor has a chance to ask one?
No, thank you.
Right. Thanks so much. There's actually an audience question that I'm also curious about. I think you did mention that at some point, Kit. There's a question from Marina about whether you're planning to expand to other building and construction elements made from hemp, for example, insulation. I think you had the graph, right? That was about first the retrofits and then expanding further.
Yeah, we actually already have interest from some of our customers of the profile, different lengths, different shapes, mainly for the acoustic benefits, because hemp is great at dampening the sound, and so that's more that we're making more of that benefit rather than the low carbon side. One interesting project is we actually have an acoustics engineer working with us. They're working with a gym distributor, and to fit out this gym in central London, they want to dampen all of the sound. So if there's a weight that drops onto the ground, it doesn't travel through the whole of the gym. And so we've actually turned our vertical stud, into a rail, sitting them onto rubber isolators and creating a suspended flooring. And then you can have your boards, your cement boards, your tongue groove boards. So that's actually, and we've already tested that. Gym distributor loves it because they're currently using steel channels to hold up their boards. And yeah, that's something that we're working on, creating a variation. We don't actually have to do too many changes. It's actually the same C profile shape, just a slightly modification on the flanges. The other application is an acoustic board. So we already make 2.5 meters by 1.5 meter boards, and we cut those down to strips to make the studs. So there's a customer that wants to use that as an acoustic board, where they're using 2 layers of plasterboard to kind of help with the acoustics and also to stiffen up the wall. They can now use just a single layer of plasterboard, our acoustics board, and then paired with our studs, and still reach the same benefit in terms of acoustic performance. What that means is now they're reducing the amount of space and not having to use two 12mm boards. They can use one, and the thickness of our board is only 4.5 millimeters. So there's some space saving there, but also cost saving instead of having to buy an extra additional gypsum board.
Mm-hmm. So maybe the price parity is not there yet, but except for the sustainability component, there's also this added benefit of the acoustic, how do you call it, buffer, let's call it, that actually could be an interesting niche for specific types of demand.
Yeah.
Great. Is there any other question from the investors towards Kit? No? Great. In that case, Kit, thank you so much for your time and for the presentation and for your thorough answers. And that is going to conclude the startups we had joining for us today. So quickly on exchanging contacts, if there's any more questions that investors have or want to follow up with the startups, you're most welcome to find all the founders on the Circle platform. But if it's easier, you can also just reach out to me for contacts if you haven't jotted them down for the presentation. So let's make sure this is easy for you to do. And then before we finish, there is a question I have for investors. So I'm going to ask each of you to indicate the startup that caught your eye the most from today's session. So maybe you can start with Nelly.
Okay, so maybe this answer may be a bit biased because from all of the pitch, I think that's only one falls or is likely to fall into my investment thesis, and it's BAIE Minerals. At the stage we are mainly exploring everything linked to supplementary cement materials. So if it were more major, it can be something that we will be interested in. But I think that's the sector is quite new and maybe too early for us. But we are following this sector closely and see if there's any potential opportunity with you. I think it was I do not remember the name of the guy who pitched. Mike.
Yeah. Awesome. Thank you so much, Nelly. That makes perfect sense. Peter, what about you?
Yeah, I really enjoyed learning about all of the different companies today. The interesting thing is that I've been looking for a company around Series A, and I know GoEve did not present, which was
sadly.
see. But nonetheless, I really enjoyed and thought was interesting Zero Circle. That to me, with some level of proof points with commercial traction, has been quite interesting, as well as the pipeline. I think I would be curious to dig in more about the use of funds of the raise and seeing that sort of translate, I guess. So that's where my head was at.
Mm-hmm. Great. Thank you so much. And Michał, what about yourself?
I enjoyed many of those presentations. They're interesting. I would share a lot of Nelly's opinions. This seems, the mineral company seems to be the most mature technologically, yes. Yeah, let's see what happens next, yes.
Mm-hmm. Yeah, makes sense. Did I interrupt you there, Michał? Sorry.
No, just...
Okay,
that's it.
Great.
Thank you.
Super. Thank you so much for sharing. And with that, we're going to conclude this session. So thank you all so much for joining founders, investors, the audience. We're going to be organizing more of these in the future. So I hope we all keep in touch. And if Peter, Nelly, and Michał are interested in hearing more about the startups from the Forward community, then we're going to definitely arrange that. And so I wish you all a great rest of the evening, of the week. And again, thanks so much for joining and for your time on this Wednesday evening.